In this video, we're going to discuss mortgage closing costs. Mortgage closing costs can be very expensive, up to 4 or even 5% of your total loan amount. Some can be negotiated, some can't. So hopefully this video will help you figure out what to expect when you get to the closing table, what you can negotiate and what you can't. There are numerous different costs associated with closing a mortgage loan. Generally, we're going to group these costs into 4 categories: title fees, prepaids and per diem fees, lender fees, and mortgage insurance. We'll go through each individually. The most important thing in owning a home is the ability to transfer the title from the previous owner to you. You need to make sure you're on the title of this new home, which is critically important to your protection. So to do that, there's numerous title fees. The title search, the title insurance company is going to do a search to see who has ownership rights on the property. That they're going to do that through a title search, and they're going to charge a fee for that. Then there's title insurance. In the event that someone claims ownership in your property after the closing date of your home and tries to take your home away from you, the lender will have insurance to protect them against that happening. Third is the recording and registration taxes and or fees depending on your state. So your state's county, the county in which you're going to buy your property, is going to want you to be registered as the owner, recorded on the title of your property, and your county is going to charge a fee for that, of which the title insurance will pass on to you. And then fourth, there's going to be numerous different types of fees. Whether it's you're in a state where a notary can close your loan, you'll see a notary fee. Some states require attorneys to close real estate transactions, in which case there'll be an attorney fee. Mortgage companies almost always require you to open up an escrow account, and the mortgage company will be paying your annual property taxes and either your semi-annual or annual property insurance fees on your behalf. They do that because they want to make sure these things are paid timely so there's no liens against your property. To do that, they're going to need some money up front to fund this escrow account. And so you're going to be prepaying a certain number of months of property taxes and certain number of months of insurance, depending on when your loan closes relative to when property taxes are due. Also, daily interest. The way mortgage loans work is can only be calculated for 1 month at a time. So you're going to need to true up the number of days of interest between your closing date and the first of the next month. So if you close on the 15th of the month, you'll have 15 days of daily interest you're going to have to pay, and you pay that upfront at the closing table. These 3 fees, there's no point in negotiating these. These are going to be the same amount regardless of which mortgage lender you choose. However, of course, you can negotiate property insurance by getting quotes from multiple insurance companies, but you can't negotiate property taxes, and you can't negotiate how many days interest you're going to have to pay. The next set of closing costs are called lender fees. Generally speaking, all these fees can be negotiated with your mortgage company or the bank in which you're closing your loan with. The first is the loan origination fee. Some banks charge this, some don't. This is the one fee that you can negotiate. If they're trying to charge a 1% loan origination fee, see what you can do to either waive that fee entirely or reduce the amount of it. The second are discount points. These are optional. So you either have them or you don't. People pay discount points to lower the interest rate on their mortgage. Your mortgage banker can explain if he believes, based on today's interest rates, if that would be beneficial to you or not. The third is the appraisal fee. Some mortgage companies charge this upfront at the time of application. Others are going to not charge you upfront and expect you to pay this at the closing table with all the other fees. The appraisal fee generally ranges between $350 and $550. And then there's a bunch of different fees the lender may itemize and charge you, such as an underwriting fee or a fee for the credit report that they got to purchase from the credit reporting agency. And there's a ton of other miscellaneous fees. There could be inspection fees, pest inspection, property inspection. There could be a survey fee that's required. If you're on a floodplain, there could be a FEMA flood insurance fee. They could be charging courier fees if they've got to move documents between you and the title company or you and the county. So it's very important for you to look at your HUD-1, that's the document that the bank has to give you, and look at all these different fees, ask questions about them all, and see which fees you can negotiate or have removed entirely. The last closing cost is mortgage insurance, also called PMI or private mortgage insurance. Now, if you're putting 20% down, there is no cost for mortgage insurance. But if you're putting less than 20% down, there will be a cost for that. Now, the cost of mortgage insurance gets reduced the more money you put down. So if you can put down 15% down, that's going to be cheaper than if you put 10% down, which will be cheaper than if you put 5% down, etc. Now, this fee could be billed monthly, in which case you're not going to see it itemized as part of your closing costs because they're just going to bill it into your monthly statement. Other times, the mortgage insurance will be expected to be paid up front, and so you will see this itemized as one of your closing costs. There is actually a hybrid version too, where some of it is paid up front and some of it is paid monthly. In that case, you will see some amount in the itemization of all your closing costs. In conclusion, typically, mortgage closing costs are going to range anywhere from 2 to 4%. You'll see some websites estimate that they could be as high as 6%. That's pretty rare. That would happen for people with low credit scores and very small loan amounts. But generally speaking, they're in the 2 to 4% range. Some states and counties are higher than other states and counties. The more money you put down, the less PMI or mortgage insurance you're going to pay. Lender fees can be negotiated. You should avoid paying loan origination fees if at all possible. And the closing costs are not counted towards your minimum down payment requirement. I hope you enjoyed this video. I have another video that discusses the minimum required down payments to purchase a home, which you may enjoy. Thank you very much.